wasn't new sanctions that crashed Russian stocks. Hello, I'm Vadim Poklopkin. Welcome to the chart of the day. News of Mark Zuckerberg's congressional testimony on how Facebook handles user data, including access to it by foreign parties that exploited Facebook to influence the US election, invites us to talk about Russia as well. If you follow our research, and especially the research by EWI's sister organization, the Socionomics Institute, you've seen us comment on Russia and its markets for years, especially at critical Elliot wave junctures. For example, Alan Hall's 2007 Socionomic study of Russia correctly identified a major positive extreme in Russia's social mood, manifested by that year's peak in the country's stock market, the RTS. That 2007 forecast called for lower Russian stock prices, the souring of US-Russia relations, military activity on Russia's borders, Putin remaining in power, and a general turn towards more belligerence in Russia's international affairs. Fast forward 11 years and, well, I don't have to tell you just how eerily precise those forecasts turned out. And here's another forecast. This one much more recent, made last Friday, April 6. That day, the US announced a new round of sanctions against Russia. Friday evening, our European short-term update gave this bearish forecast for the Russian stocks. The Russian RTS index future is declining in wave C, but it needs to start declining quickly to prevent more bullish scenarios coming through. Some might say, well, of course, a new set of harsh economic sanctions would make the stock market go down. In fact, most mainstream analysts said exactly that. Yet, notice that our forecast did not make a single reference to the news. It only looked at the developing Elliott wave pattern in the RTS. In fact, on April 4th, the European short-term update made the exact same prediction, 2 days before the new sanctions were announced. The June Russian RTS index future is declining in wave C. This next chart shows you the extent of the decline, 11% in a single day. For US traders, the Van Eck Vectors Russia ETF, RSX, dropped 10% that day. In the April 9th European short-term update, editor Murray Gunn wrote, "We said on Friday that the Russian market had to start declining quickly to keep the bearish wave count on track. It certainly did decline quickly today, so much in fact that our wave analysis reflects an even more bearish situation. Today's dramatic decline is part of wave 3, meaning that there is probably more pain ahead for Russian stocks. But they won't get there in a straight line. There will be rebound rallies and sideways days. Each time you'll read news stories with after-the-fact explanations of why Russian stocks did what they did. And each time, Elliott wave patterns will flash signals to help you anticipate the trend before the fact, like they did back in 2007, or on April 4th and 6th, or as they're doing right now."